Hey everyone, Joe Lentini here. This bill brings sweeping changes to the federal student loan system, including new borrowing limits, repayment structures, and program accountability rules. Loan limits, graduate and professional loan reforms, ends eligibility for Grad Plus loans starting July 1st, 2026. New annual borrowing caps for federal direct unsubsidized loans. $2,500 per academic year for graduate students, $50,000 per academic year for professional students. Aggregate limits for total loan amounts. $200,000 lifetime cap for professional students. $100,000 cap for graduate students who never enrolled in a professional program. Students with both degrees are capped at $200,000 total, but their prior graduate loan usage reduces what they can borrow as a professional student. Parent loan limits, Parent Plus. Beginning July 1st, 2026, annual limit per dependent student, $20,000. Lifetime limit per dependent student, $65,000. Applies across all parents, not per individual borrower. Universal lifetime borrowing cap. All students are subject to a $250,500 lifetime loan cap, excluding Parent Plus. This includes all loans across undergrad, graduate, and professional education. Repaid, forgiven, or discharged loans still count toward this cap. Additional loan limit rules. Part-time students. Loan limits are prorated based on enrollment level. Schools may set additional program level caps on loans per year, as long as those caps are applied uniformly. Grandfathering, students enrolled as of June 30th, 2026 can retain current borrowing rules for up to 3 years or the remainder of their current program, whichever is shorter. Loan repayment, new repayment plan structure, effective July 1st, 2026. Borrowers with loans issued on or after this date must choose one of the following. Standard repayment plan, fixed monthly payments based on total loan debt, total loan balance less than $25,000 repayment term of 10 years, total loan balance between $25,000 and $49,999 repayment term of 15 years. Total loan balance between $50,000 and $99,999 repayment term of 20 years. Total loan balance of $100,000 or more. Repayment term of 25 years. Applies to all loans uniformly. Prepayment without penalty is allowed. Repayment assistance plan RAPE. A new income-driven repayment IDR option for loans issued on or after July 1st, 2026. RAP key features. Monthly payment is income-based using a tiered formula. Forgiveness after 360 qualifying monthly payments. Borrowers can switch between RAP and standard plan at any time. Borrowers with accepted loans, example Parent Plus, certain consolidation loans, are ineligible for RAP and must use standard repayment. Married borrowers will be allowed to omit spousal income if they choose to utilize married filing separate status on the tax returns. RAPI payment formula. Applicable monthly payment is calculated as a base percentage of the borrower's adjusted gross income, AGI. Income under $10,000, 10 monthly, $10,001, $20,000, or 1% of AGI, $21,000, $30,000, 2% of AGI, and increases by 1% per $10,000 income, capping at 10% for income over $100,000. Then subtract 50 per dependent. If the result is $10, borrower pays $10. If borrower fails to provide income data, payment is calculated as a 10-year standard amortization on their balance until documentation is submitted. Forgiveness under RAP. Borrowers who make 360 qualifying payments, 30 years, will have any remaining balance forgiven. Qualifying payments include RAP payments, payments made under standard repayment equal to or greater than RAP amount, payments made under other plans, example IBR or ICR, before RAP enrollment, deferment months due to military service or economic hardship, certain forbearance periods prior to the effective date, consolidation loans. Consolidation loans issued on or after July 1st, 2026 can only be repaid under RAPI or standard repayment, may not be repaid using older IDR plans. Consolidation loans that paid off Parent Plus, including double consolidation loans, are excluded from RAP eligibility and must use standard repayment modifications to existing IBR plans, and impacts to current borrowers in repayment. The current income-based repayment plan, including new IBR from 2014, remains available for borrowers who took loans before July 1, 2026. With WRAP now being referred to as an IBR plan and two versions of IBR already on the books, this language gets very confusing. We'll refer to the existing plans as Legacy IBR. Eligibility no longer requires financial hardship. Original IBR. Monthly payment is 15% of discretionary income with 25-year taxable forgiveness. New IBR modified in 2014. For those who only have federal direct loans disbursed between July 1, 2014 and July 1, 2026, monthly payment is 10% of discretionary income with 20-year taxable forgiveness. Discretionary income to AGI is 150% below poverty guideline. If you are currently repaying loans using ICR, Pay, or Save, you must transition to WRAP Legacy IBR or the new standard plan by July 1st, 2028. That said, those in the Save plan should probably expect to be forced into another plan much sooner. As always, we're here to help you navigate these new rules and make the most of your tax situation. If you have questions or want to discuss your personal circumstances, please contact our office. We're committed to helping you thrive under the new tax law. If you'd like to schedule a tax planning phone appointment to discuss the impact on you and your family, our special summer rate of $75 for a 30-minute consultation, which is 50% off our regular rate if scheduled between now and September 15th. Then the rate through October increases to $125 for a 30-minute consultation, and finally the full-time rate of $150 will kick in after October. We're here to help you and would love to discuss how we can help you make the most of these new tax laws.